Hello, everybody. This is Toni Turner, and welcome to the market now as of Friday, June 26th, at the market's close. Well, Wall Street's major indexes dropped today as the United States, nothing to be proud of, set a new record for a one-day increase in coronavirus cases, and bank stocks fell following the Federal Reserve's move to cap shareholder payouts. The uptick in the COVID cases has also threatened to derail a strong rally for Wall Street that brought the S&P 500 within 9% of its February all-time high on the back of record government stimulus measures. And on that note, let's go on and look at three charts that could give us a little insight into the week to come. First of all, as we always do, we're going to look at a daily chart of the S&P 500 SPDR, symbol SPY. As you all know, this is the tracking stock, or the ETF, that closely follows our S&P 500 benchmark index. Now, at the close today, the SPY closed at $300.49. Now it is 11% off of its all-time high that we just talked about in February, which was at $338.34, or around $33.83 on the S&P 500 itself. So as we all know so well, it dipped way down to about 218 on March 23rd, then has been rallying in a really nice uptrend ever since. But that uptrend is starting to weaken a little. Pretty good for a freehand straight line, huh? That uptrend is starting to fall down a little, to weaken a little on the past few days and weeks of coronavirus action. So again now, the SPY is a little over 10% below its all-time high, and we call that, actually it's about 11%, below its all-time high. And when an index or asset is 10% below its all-time high, we say it is in correction territory. Now, the SPY did fall below its 20-day moving average, the red line. These are all simple moving averages, and did close today below its 200-day moving average. That's the black line you see right here. So what we could be looking at now, pattern-wise, potentially could be, and it's not there yet, it isn't there yet, but if it breaks below this support, we have price support here at about 298, about 2980 on the S&P 500. We have moving average support. So when you have both price and potential moving average support, that can be is the operative words here, could be pretty strong. So if, excuse me, if the SPY should drop below the 50-day moving average, which is coming in now, that's the green line, coming in now at $297.65, then if it closes below that support, this is kind of a head and shoulders looking top reversal pattern, then we could see the SPY potentially drop down toward 280 or 2800 on the S&P 500 itself. So, of course, fingers crossed that it doesn't drop below that 50-day moving average, because that's a line of reckoning, especially with a lot of institutional traders. So please, in the coming week, if we do see like a head and shoulders pattern here, if we do see it close below the 50-day moving average, and especially if it stays below it for 3 full days, trading days, please be putting in your protective stops now. You don't want to give up. We certainly don't want to give up the profits we've made in this last rally that came up like this. So wait to see what happens. Be wise, and again, check your protective stops. Now our next chart is a daily chart of the Invesco QQQ. As you all know, the QQQ follows our very important index, especially in this last rally since the March 23rd fall because of the coronavirus. The Invesco QQQ, of course, following the NASDAQ 100, does contain the top momentum players in the NASDAQ stock market, and of course that includes Apple, Amazon, Facebook, Netflix, that whole group. So it has had a spectacular move up. As you can see, it's pretty well from these lows, but down here in the 160s, it has ridden up in an absolutely beautiful uptrend, actually following pretty much, riding up its 20-day moving average, the red line, and staying above it closing-wise until today. So today the QQQ at the close was trading at $240.22, just below, just barely below the 20-day moving average. Now closing here, it is just about 2% also off of its all-time closing high that it touched on June 10th. That was right here at $246.22. So now it's broken again just below this 20-day moving average. We're looking at support here at about $231. That would be price support here at about $231. If it should go down below that, just hopefully it doesn't, but if it does, if it breaks below that 231, then potentially we could have a shallow, small and shallow, but nonetheless double top here. Now I've measured these two tops. This was the all-time closing high back here at the beginning part of June, end of May, beginning of June, and this was the last all-time closing high. As long as if you have this kind of pattern and you have two highs like this, then it retraces, then comes back. As long as the second high is within 4% of the first high, we can legally call it a double top. But now it isn't a double top until or if price comes down and falls below what we can, looks like an M, doesn't it? So until or if price comes down and closes below the bottom of the M, we'll call it right here. In this case, again, that would be about $231. So if that happens, then we could see potentially another leg to the downside, especially if it crosses below the 50-day moving average, which currently is coming in at $228.92. So we've got a lot going on here. Also a really kind of quick, interesting point here. Notice that the 14-day RSI back here when in the first part of June, when the QQQ ran up so high, the RSI followed it and became overbought, then fell down here just as the pullback came in to the QQQ. But note here, when it came back up, the RSI did not become overbought again. It made a lower high. The QQQ made a higher high. Whenever you see that happen, we call this a negative divergence, because price went higher, RSI actually made a lower high. Negative divergence usually means that most of the time price will end up doing what the indicator says it will do, which is at the moment, of course, a lower high moving toward the downside. So nothing dramatic, but certainly a quick note there if you want to observe it. So if you are in a lot of these momentum stocks, the big growth stocks, you really might want to set your stops now, maybe even take some profits, because you sure don't want to give back all the good profits you've made. Our final chart for the day is the Van Eck Gold Miners ETF, symbol GDX. Now I've gone back to this chart. I know we've looked at it sporadically in the last few months. I've gone back to it today because I'm sure you know by now that the coronavirus is causing this country, after a lot of states have opened up, and I'm in Florida, I'm in one of them, that is opened up pretty well, and now we're kind of worried if we're going to get shut down again, and certainly we're worried about coronavirus spreading. So if the market starts down again because of that, you may want to hedge a little bit, or you may want to look at the Van Eck Gold Miners ETF, again, symbol GDX. Many times when the market goes down, the gold miners will go up. Now in this case right here in March, the gold miners went down, certainly did go down dramatically, but it rallied quickly and then came back up. And as now, right now, the GDX is sitting on its 50-day moving average and its 20-day moving average. As you can see, the 200-day moving average is down lower. So down here at $29. So it dropped to $16.18 back here on March the 16th. Then again, as I said, rallied up to a new relative new high in mid-May to about $37.50. Pulled back to the 50 and the 20-day moving averages, and is now sitting on this 50-day and 20-day line, looking like it may want to go higher. So I'm going to keep an eye on the GDX in the coming week, and if the market starts down and gold miners, and by the way, you can also trade, if you want to, the GLD, which is the Spider gold shares, the GLD, I should have put an L right there, or the IAU, which is the same thing, iShares, gold shares. Thing is, these are both commodities ETFs. They track the actual commodity, the spot price or the daily price of the actual commodity of gold, both of them. The thing is that if you're trading these in a traditional trading account, you have to make sure that at the end of the year, you or your bookkeeper or accountant knows exactly how to figure out the taxes for the profits that you've made, hopefully the profits you've made, because it's a little different tax structure than the equity ETF that I'm talking about here. So you can do this, but make sure to check to make sure you've got the right tax information. It's actually a favorable tax on anything that's a commodity, but you still want to know about it. So I'm talking about the GDX here because these can be traded in traditional accounts as well as tax-advantaged accounts. So the VanEck Gold Miners has 54 holdings. The top holdings include Newmont Mining, Barrick Gold, Franco-Nevada, Wheaton Precious Metals, and Agnico Eagle Mines, among others. Now today we can see that the GDX closed here at $35.19. Again, it went up to this relative new high of $37.50, then it came back down, then started walking up its 50 and 20-day, in the last few days, its 20-day moving average. Now, again, if the market starts down next week, I'm going to keep an eye on the GDX. I may add a small position to my portfolio. I'm pretty much scaling in and into everything right now. So I may add a small position of the GDX to my portfolio. My initial stop I'm going to place at $33, and that also gives me enough room to be here just a little bit below this support point here. If the GDX can head higher and even head up, break these prior highs right here and head up to $38, I may add more to the position. I will certainly turn my stop into a trailing stop. And some of you may want to use the 20-day moving average. It closed below that as a stop. You can do that. That's a reasonably tight moving average, but definitely a trailing stop. Now, if the market heads lower, of course, and the GDX has, if the GDX, heads lower rapidly, I do remain the right to jump out of this trade quickly before it reaches my stop if I need to. So if the market heads lower, or if the GDX starts up in the coming week, you may want to keep an eye on it. And with that, please know that right now, before we go on to final thoughts, we are now offering 20% off, a 20% off discount on my popular online trader training, Trade the Trend to Profits. If you want to discover an easy and powerful strategy to grow your portfolio, please check this offer out at the link on this screen, or simply click on the orange button below. This is going to be a limited time offer, and we are not going to run it much longer. So if you're interested in learning how to trade the trend, please click on the orange button below or check out this link right here. Okay, with that said, let's go on to our final thoughts for the day. Question is, do my personal patterns synchronize with the market's patterns? Do my personal patterns synchronize with the market's patterns? Now, please know this. This is kind of interesting. We overlay our own personal patterns on top of the market's patterns every day that we trade. And the outcome of the combination of those two dictates our trading success. Now, I know you're aware that your personal patterns change every day. And of course, the market's pattern changes constantly. So to be a consistently winning trader, to be successful, you need to approach the market with a mindset or a personal pattern of calm confidence, because you can't move the market's pattern. You can't change that, but you can make sure that your own personal pattern is a really good one. And we always use, my students and I use the kind of the attitude or approach, calm confidence. That means you're calm, you're not upset, you're not anxious, you're not nervous, you are calm. And confidence comes not in the total confidence that your trades are going to go where you want them to, but in the confidence that you have a trading plan and that you are going to adhere to your risk management. So again, if you're tired, anxious, or upset, you're going to find it difficult to be in sync with the market, and it's going to be very difficult to make the best trading decisions. As well, you'll probably jump into trades without plans, and you won't be able to think clearly enough to exit the trades when you should. Now, knowing this, again, decide to come to the market each day with an attitude of calm confidence. That's going to be your pattern. If you can maintain that personal pattern, no matter how the market is trading, your road to success is already partially established. Next, you need a trading plan for each new trade, absolutely. You know, where to get in, where to get out, and you need a risk management plan for each open position. Now, if our personal pattern and our trading plan and the actions we take agree with the market direction, then most of the time we do well. If our pattern and trading plans don't sync up with the market, then we experience losses. So check your emotional patterns and your trading patterns around your risk management. Try to approach the market with a personal pattern of calm confidence. Also remember to try to make sure your trades are aligned with the overall market pattern. With those two things in place, you should be able to raise your levels of trading success. So for now, please remember that our already low-priced and popular online trading program, Trade the Trend to Profits, is now on sale at a 20% discount. Until next week, keep green on your screen. I'm Toni Turner, and this is The Market Now.